People want you to think that you can't make money using stock options, but I'm going to show you how to do it right here using the Robinhood app. You're going to need a few things. I got a list. You can screenshot this list, and it says get started on Robinhood. You're going to need to be 18. You're going to need a social security number, and you're going to need a bank account so you can fund your account. The social security number is so you can be taxed, because when you make money, taxes come with that. First, I'm going to give you an example of what getting into an option looks like, and then we're going to explain it in detail as to how to get in and what options to look for. So here's our example. You open the Robinhood app, and on the bottom, we're going to click on the magnifying glass, and then we're going to look for a stock. We pick Apple. It has a ticker symbol or a little tag that helps us to find it. It's AAPL. We click on Apple, and we can see the Apple share price. The Apple share price is currently $270. We're gonna click trade, and that opens up a list. We're gonna click trade options. Now we look for a date to buy a call, and it says 280. That's called the strike price. And we're gonna click on this. On the bottom of this page that pops up, we're gonna click buy, and it's asking us how many contracts do we want on the top. We're gonna click 1, and our limit price, meaning the max that we wanna pay for this, is $395. We click review, and then we have our position. When we look into our position, it says we have one contract that costs $388, and our total return is 0. If we scroll through and open up our position, we can see our contract, and now we can sell out of it, because you don't have to hold on to options until their expiration date. You can sell them whenever you want, as long as the market is open. We'll click trade, and then we'll go to sell. And if the options contract ran up from $388 to $500, then we would be able to sell it at whatever price it is. So hypothetically, let's say it ran up to $500. We click continue, and we could sell out for a profit right now. But that was an example for how it looks to buy an option, and then to let the price go up, and then to sell the option for some profit. Now let's look at the process step by step, and I'll hold your hand through it so it's not difficult. If you go on your Robinhood app and you click trade and you don't see the options list, what you're gonna have to do is apply for stock options. On the app on the bottom, you're gonna see this little person on the right. You click on that person, and then all the way in the top, you're gonna see 3 lines. Click on those 3 lines, and then we're gonna go to investing. I highlighted it under here in blue. Then, as you can see on mine, I have level 3 trading, but you don't need level 3 in order to trade stock options. This just means what level of risk are you comfortable taking. Now, mine says open settings, but yours might say apply for options. So when you apply to this, this is how you're gonna get access to options. If you apply and you don't get approved, come back to this video and send me a comment about it. Now let's get into understanding what all of these things mean that we just talked about in the beginning. Because here, I wanted to show you what the process looks like, and now we're gonna explain it piece by piece. Are options risky? The answer is yes. However, if you have knowledge and strategy, which I'll teach you in this video, it reduces the risk significantly and increases your chance of making some profit. Let's start over from the top and go to Apple, and we can see that Apple is $270. Whenever you're picking an option, you need to pick a date. If you pick today's date, that's called a 0 DTE, or 0 days to expire option. Because one of the main differences between stocks and options are that stocks don't expire. If you bought Apple at $270, then if Apple dropped down and went back up, as stocks often do, then you can just hold on to it and wait for that great company to just get higher in price. But options, it's best to get out of them before the expiration date. Now let's think about what options to choose and when. If you believe the stock market is going to go up green, then you call up, kind of like on a phone. And if you think the market is going to dip down, then you put down. So remember that, call up, put down. If the market is falling, then you buy a put option. And if the market is running up, you buy a call option. But there are some differences between options. There are these numbers on the left, and they're called the strike price. Apple's current price is right here in blue, and it's $270. If I look at a strike price that's $275, and it's a little bit higher than Apple's share price right now, that's called OTM, or out of the money. If I look at a strike price that's lower than the current price, like $265, then that's called ITM, in the money. OTM contracts are going to be much cheaper, and ITM contracts are going to be much more expensive. Let's take a look at an example. You can see up top, it says 47 cents for the 275 strike, and down here it says 675 for the 265 strike. So significantly more. Let's look at another example. The 0 day to expire 272.5 call is going to cost $111. That's out of the money because it's higher than the current share price. We have 270 flat, and that's going to cost $2.34 because this is in the money. Now, out of the money, in the money, why do we care about this at all? And the reason is this. If you look at the 275 call, that's 47 cents. The break even percentage is 1.6%, meaning Apple has to move 1.6% up by the expiration date in order for you to make a profit. But if we look down here at the OTM 265 call, that only needs to move up 0.1% in order for you to make a profit by the expiration date. So what this means is if you want to buy OTM contracts, it's going to take more of a move for you to make money if you hold it until the expiration date. And if you buy OTM contracts, then your chances of making money is higher because the stock price doesn't need to move up that much in order for you to make that break even. This is how I want you to think about OTM or ITM. The OTM contracts are cheap, but not everything cheap is good. Sometimes there's a reason why things are cheap. Think about it like this. If you go to a dealership and buy a car part, you're gonna pay more, but you expect it to work. But if you go to a junkyard and you buy a car part, you expect it to be cheap, and you expect that it might work. So sometimes you get what you pay for, but you can't expect a junkyard part to be as reliable as a dealership part. They both might work, but sometimes you get what you pay for. And I'll show you a simple cheat sheet part on how to make sure that you're getting OTM contracts that have a higher chance of winning. Once you open a contract up, all you gotta look for is one thing, and it's called delta. This is an options Greek. When you see delta and it's 0.65, this is telling you in simple terms that you have about a 65% chance of actually making some money on this contract. If you go and look at the OTM contracts, the out of the money contracts, then you're gonna see that their delta is often very low. You might see a 20% chance. You might see a 10% chance. So when you go and search for options contracts, you should look for 0.65 or close to give yourself a little bit of an edge so it's not 50-50. Now this is how you can pick contracts. You're gonna look for these two things. The first thing, you're looking for an option that's 2 weeks out with a delta around 65. Once you have those two things, you are in a higher probability trade. Now when you open the option, it's gonna ask you, what do you wanna pay for this? There's a bid price and there's an ask price. The bid price, $11.05, and then the ask price, $11.40. You want to pay somewhere in the middle. So the last trade I highlighted in blue says $11.30. This is what the last person who took a trade actually paid. But you're trying to get lower than the ask price of $11.40. So I enter into the trade and I see that I have one contract at $11.23, and in options terms, you have to multiply this by 100. This option actually cost me $1,100. But remember, this one costs a little bit more because it has a higher chance of winning. Most people don't win in trading because all they do is buy the low chance out of the money contracts. But in this video, I'm teaching you how to do a higher percentage win. And you gotta pay a little bit more to be able to do this. So instead of buying $20 contracts, you'll increase your win rate significantly by starting to buy $1,000 contracts. And if we're looking at my order, my total return right now is 0, and my expiration date is 5/15. But I don't plan on holding it until 5/15. I want to make a profit, get in, get up, and get out. Now, when do I sell? If we see that I paid a market value of $1,123, I'm not risking $1,123 just because the option costs that much. That's a rookie mistake. You have to pre-plan how much you're willing to lose. The easy way to do this is only risk 10%. So if I'm in this for $1,123, then I'm only going to risk those first three numbers, which is 112 or $112. So once I see on the bottom, if my total return said negative 10%, then I would sell out of this. No questions asked, no hoping and wishing that it turns around. I would totally sell out of this because I'm only willing to risk that 10% with discipline. This is how you remain profitable. Now, when do I sell it? If it goes up to the upside. If I see my total return be 20% or 2 times what I'm risking. So if I'm risking 112, I'm trying to make 224. So I'm only allowing this thing to potentially go 10% down, but I'm looking for 20% up. This increases my chance of being a profitable trader significantly. Now, here's how I would get into the trade. I would open up Apple on the charts. You can use an app called TradingView. You can even use Robinhood or any charts that you can look at candles. If you need help with that, let me know in the comments. And I would go to the time frame called 5M. This is 5 minutes, meaning every single one of these candles is a 5-minute increment. And when the market opens Eastern time at 9:30, I would look at the first 3 candles. I would let them go 5, 10, 15. And after those first 3 candles are closed out, I will put them in a box. From the very tops and bottom of those little lines, they're called wicks. And then we can see the rectangles inside of there, and they're called the candle bodies. So what I'm waiting for on this 5-minute time frame is a candle body to end up being higher than that white box that I drew. So I highlighted it right here in white, where I see 20 minutes later, I got a candle body that closed out higher than that box that I drew. So then I would buy a call because I expect the stock to go up. What option do I pick? Let's do a review. I would go at least 2 weeks out, and then I would look for a delta of at least 0.65. This is gonna put me in the money, so I have a higher chance of actually making money. It's not gonna be a $20 contract or a $50 contract. It's probably gonna be close to $1,000 of a contract, but I'm paying for quality. I'm going to the dealership to get a part, so I have more reliability versus going to the junkyard just because I want something cheap that may or may not work. Oftentimes, many people are so interested in the cheap ones only, and sometimes there's a time for that. But if you're trying to be consistent, then you have to take this very seriously, and this is why I'm giving you this game right here on this video. So after I enter into the trade, if it drops down 10%, I would let it go no matter what. And if it goes up 20%, then I would sell out at a profit. And if we look at the charts, after we got in at that white line, after we got the close of the candle body above the zone, then we would ride the wave all the way up and then be able to sell it at our 20%. If you got value from this video, put the letter V in the comments. And if you want to join KGU, which is Keenan Graces University, and actually watch me trade in real time, then the link is going to be in the description. I look forward to seeing you. Share this video with somebody who wants to learn how to trade options, and good luck on your journey. Take care.